With Donald Trump return to the White House, the year 2025 promised significant volatility for financial markets assets. Protective measures, such as a tariff on products from another countries, interventions in conflicts between Ukraine and Russia, and Israel against terrorist groups in the Middle West, or even simple statements on his Twitter profile could impact the stress of the dollar and move stocks indices. Initially, the market foresees economic growth in the United States. Consequently, a trend of gains is expected in major U.S. indices such as the S&P, Dow Jones, and Nasdaq. Jeremy Powell, chairman of the Fed, has already stated that there will be fewer interest rate cuts in 2025, considering that economic overrating could reignite inflation. This pause in interest rate cuts also strengthens the dollar against global currency pairs, given the attractiveness of U.S. Treasuries. Trump's stance on tariffs on Chinese products remains uncertain. However, one thing is certain: if tariffs are imposed, retaliation will follow. This scenario could trigger a trade war that would not be beneficial for either side or the world. Additionally, the global energy transition could gain or lose momentum, depending on the policies adopted. Trump has already expressed support for fossil fuel exploration, which could impact renewable energy companies and generate global climate tensions. In Europe, economic challenges continue to grow. The region faces a narrow margin to avoid recession, especially after the recent interruption of Russian gas suppliers, which increased energy costs and affected critical industrial sectors. This scenario could limit Europe's growth and increase dependence on alternative energy sources. Furthermore, the Europe Central Bank has entered a cycle of interest rate cuts to stimulate the economy. However, his approach has also contributed to the weakening of the euro against the dollar. Specialists already foresee parity between the two currencies in the medium term. Another point of attention is the behavior of emergency markets. Countries like Brazil and India may benefit from the search for alternatives to Chinese supply chains, while a stronger dollar could pressure local currencies. On January 20th, it will be crucial to monitor statements from the new President of the United States, especially to identify potential challenges in the next administration. I will stay attentive to future developments and their economic impacts. Goodbye.